So Reserve Bank of India Governor Sanjay Malhotra now firing on all cylinders. Whatever was the expectations from the market, he has delivered. There is a 25 basis point rate cut, but more importantly, there is a shift of stance to accommodative. Now he has clearly mentioned there are only two options from Reserve Bank of India, either to cut rate or remain neutral. But more than that, you would have noticed in his speech he has used the word comfort if he is talking about inflation, although the risks are remaining, but there is a downward revision of inflation as well as growth target. We have with us a host of panel to discuss what it means. We have Ashima Goel as well as Dinesh Khara. Welcome to the special show. Ashima, I want to understand from you first, do you find this tone to be dovish?
Yes, I think it is. It is actually, as economists, we don't like these bird language. So accommodative is the same thing as dovish, soft. The policy is definitely accommodative. The stance is also shifted to accommodative now. And therefore it is growth supportive. There is comfort that inflation has the forecast is for inflation to be at the growth target this year. So this is the correct stance at this point.
Right. Mr. Khara, I want to understand from you, you would have heard about the announcement which is made about co-lending. Now, this will benefit all the stakeholders. What is your take?
No, I think it's a very welcome situation because particularly when it comes to, significantly strengthening the ecosystem, it will go a long way. And particularly co-lending, which was earlier restricted between banks and NBFCs, it will actually, and also it was for only priority sector loans. So actually now the ambit has been enlarged in terms of making it possible for all kind of loans and between all the participants of the ecosystem. So I think to that extent, it's a very welcome move and it will go a long way. This is what my sense is.
All right, so that's a welcome move from the RBI, a 25 basis point of rate cut that has been announced, as well as the change in stance, followed by many announcements when it comes to the GDP growth forecast as well as inflation. We also have Nilesh Shah on the show right now. Hi Nilesh, good to be speaking with you. Help us with your take on the currency front and what could be the likely impact on the financial sector, because of late this sector has been reeling under the liquidity crunch. RBI has taken a lot of steps, but at the same time, given the global uncertainties, they are hinting that there could be some pressure on the currency in the times ahead. Help us understand your first take on the RBI decision, as well as how do you see the currency moving ahead and impact on the sectors?
In our opinion, rupee movement will be linked to Chinese currency. We have started seeing offshore yuan getting closed much higher than the local yuan. And Chinese central bank is probably going to use Chinese currency to take out some impact of tariff. In our opinion, if Chinese currency depreciates, rupee should match it. We already run more than $100 billion trade deficit with China. With US market shutting down for China, their large manufacturing capacity will start looking for other markets. And we can't afford to be non-competitive with China. So whatever Chinese currency does, we have to do better in the same direction. Reserve Bank of India has intervened in the market on both sides. There were people who were talking about 90 rupees to a dollar. Well, that didn't happen and rupee appreciated. So we should let Reserve Bank of India manage rupee. They have done it with much elan in the past, and they'll continue to do that job going forward. They control the volatility of rupee and let the market decide the direction. I think that's one of the best policy that has stood the test of the time.
All right. We also have with us Mr. R. Gandhi, a former official from Reserve Bank of India. Mr. Gandhi, welcome. I want to understand from you this time unanimously there is a vote for the stance as well as cutting the rates. Now this is quite different from what was happening in the earlier regime. Do you think there is a change in the way Reserve Bank of India is now managing the inflation and growth dynamics?
Thank you. It is not just a regime change which has resulted in this. I am pretty sure that it is because of the current international situation, which is very highly uncertain. That means that we have to be ahead of the curve in preparing the whole economy to receive any shocks that may be forthcoming. So that's why it's supporting the growth, especially when inflation is well under control, as the governor mentioned that it is below target last time. So we can afford to be more in favor of growth. So that's why the unanimity of the MPC. Of course, the new committee is also new, members are new. Naturally, they can have a different view than the earlier group. So that is in passing, the regime impact is in passing. I would rather believe that the current international situation has weighed heavily on each one of the members to come to this conclusion.
Right. Mr. Khara, I want to understand from you now that Reserve Bank of India has cut rates, but deposit rate cut is something which is yet to be transmitted. Do you think that will happen in the current quarter now?
Well, that is a function of the liquidity which is there in the system and also the kind of growth which normally the banks witness as far as the credit is concerned. So I think we have seen that some of the banks have already cut some kind of a deposit towards the fag end of, or maybe the beginning of the current financial year. But I think much of it will be I would attribute it essentially to the fact that the first quarter normally witness a lower growth in the credit. So that is essentially one of the reasons. But I would say that essentially it will be a function of the liquidity and the way RBI is intervening to ensure that there should be, the liquidity concerns should be addressed. I think that gives some kind of a confidence to the banking system. But nevertheless, I would say that it is more of a transient liquidity which is taken care of through MOs, etc. Eventually, for the credit growth and deposit growth need to be balanced so that it should actually take care of the economic needs of the economy. So I think, to my mind, it will be, maybe we can get to see some kind of a softening of or maybe the reduction of the deposit interest rates in the shorter duration. But when it comes to longer duration, perhaps we'll have to wait and watch.
Right, point taken, Mr. Khara. Let's we also have Sriram Ramanathan of HSBC MF who's joining us on the show right now. Thank you so much, Sriram, for being part of the show. And wanted to get your first views on the MPC monetary outcome, given the fact that we've gone ahead with a cut of about 25 basis points. What's key to note, there's a change in stance to accommodative from neutral, but there was no voting that had taken place. At least the governor did not mention the fact if the MPC voted in order to change the stance.
Right. No, I think I'm guessing the voting would have happened. I think because that's the policy, that's the process that's followed, I think, every MPC. But I think importantly, what the governor has also done this time, which is a huge relief to the markets, is a lot of clarity on what this whole stance means, because we have really been oscillating between various assumptions and interpretations of what stance is. I think he's been fairly clear. Stance in an accommodative stance basically means that it's a softer rate signaling very clearly, and rates are either likely to be on status quo or go lower. I think so. That is one thing. I think the second key takeaway for the market is a very unequivocal statement by the governor saying that they are seeing inflation at 4% on a durable basis over the next 12 months. I think that's quite a important statement for the markets, because on that, if you superimpose the fact that the governor also says growth is below potential, it means that real rates probably then have to be on the lower end of the band that they have referred to in the past, which means that the trajectory of rates over the next 3 to 6 months, in our view, potentially goes towards 5.5 or even lower. Because if you have a durable liquidity at 4 and 1.4 to 1.9 was broadly the band that was cited earlier, the lower end of the band, you're really saying sub 5.5 in terms of terminal policy rates, if one were to look at, and which is what I think opens up the door for a few more rate cuts than what markets are currently pricing in. Overall, I think it delivers on all the expectations that have been built in our markets already. That's why we have seen a muted reaction immediately where yields are moved up a few basis points. But I think it's plays true to what the market was really expecting from the MPC.
Well, yes, the MPC has delivered exactly the same, but the markets are definitely not looking that happy. Why so? Because we are just feels like replicating what's been happening globally. And well, of course, the RBI governor has been hinting that in India, the rural demand, the urban demand is still holding up. The investment activity is expected to pick up, but there's a lot of uncertainty that is evolving globally. And well, of course, India will be left no behind. But Ashrama, 4% CPI inflation projection that is there. But do you believe that there is a risk to this particular estimate? Because and along with that, the GDP growth rate that has been slashed with 20 basis points, what I believe that the analysts were expecting a hit of almost 50 basis points in this uncertain time. Do you believe that what RBI has come out with the projections is enough at this point in time?
Yes, I think indicatively the change in the forecast is correct. In the sense, inflation is likely to be softer than the earlier forecast, as well as growth is likely to be softer because of the international situation. Oil prices are also coming down, which will tend to reduce our inflation. So, and there is a view that the monsoon uncertainties, heat wave, but, looking at the detail, all of us tend to focus on Punjab farmers and the agitation. But a number of states have moved forward on implementing farm gate procurement, private markets. There are a lot of startups that are improving the delivery of vegetables, moving towards more weather-resistant types of crops. So I think overall, we are preparing for unforeseen weather conditions, and it's not likely to have a persistent effect on inflation. So even if there is a heat wave, that's what we saw last year also. Vegetable prices were spikes. That is why I had called for a rate cut from June, because I could see with the good monsoon and these initiatives, prices are going to come down. Now, monetary policy has to be forward-looking because it acts with a lag. So if expected inflation is 4, your repo rate is 6.5, it contributed to the cyclical slowdown, because we must remember from theory that it's the real interest rate that affects consumption and investment decisions. So therefore, I think these forecasts, growth and inflation forecasts, are correct. Both inflation and growth are soft. Well, inflation is well likely to be below the RBI's target. So there is scope to cut the repo rate in order to ensure that the real rate does not go much above 1%. In these situations of uncertain international geopolitics and economics, it's important to stimulate domestic demand, to build on the diversity in our economy, which gives us some insurance against these kind of shocks coming from the outside.
Right. I also want to draw the attention towards the inflation guidance which has been given by Reserve Bank of India this time, and also mentioned the word comfort. So all in all, does it look like shifting balancing act from managing inflation to more of growth now? Because although Reserve Bank of India is mandated to maintain the target of 4%, but this time specifically in the last policy also, Reserve Bank of India governor did mention about shifting its stance. So I want to understand from Mr. Sriram Ranganathan, how does it impact the yields going forward, and do you agree to the view that the balancing act is now for growth now instead of inflation?
While in the policy statement itself, he may not have mentioned too much apart from the rate cut, but I think all the actions that we have seen over the last few months from this governor and under this RBI indicate that the shift towards making sure that the growth slide is stopped, and really, that there's a further impetus given to aid growth. with less focus on inflation control, because inflation has been moving fairly well overall. So I think that change in shift in balances was already clear. In this particular policy, I think it's been emphasized without much doubt. I think the governor has made it's fairly clear that inflation is now durably at the target, so which means that they can turn their attention towards growth. One important thing is that while, of course, the policy itself of a 25 basis points cut and the change in stance broadly meets expectations, what you have seen from the RBI of late is a lot of proactive measures outside the policy, right? And liquidity domain is really outside the policy. And that's where, if you see all the measures so far pumping in upwards of 7 lakh crores, I think that process is going to continue. And that what's from a market perspective, I think that will continue to be a positive tailwind, because one way to look at liquidity, the need for liquidity injection, is in terms of the fact that somewhere reserve money growth, M3 growth need a lot of support from the RBI to go back to levels where they should be, because reserve money growth as of now is below 4%. Similarly, M3 growth is below 10%, while these metrics are not given that much importance nowadays, but I think somewhere they do matter for deposit creation, for credit creation. And I think somewhere the focus is to pump in liquidity a lot more than what we have already seen. And we expect those measures to continue. So all in all, I think the markets will take a fair bit of heart, the bond markets is at least, in terms of the fact that RBI is very serious about monetary transmission actually happening, which means liquidity needs to be abundant, not just in surplus. And banks, at least after the next 3 to 4 months, get the confidence to be able to reduce deposit rates meaningfully, and then pass on maybe in 6 months' time in terms of lending rates also meaningfully lower as well. So I think that's really what RBI seems to be wanting to do. And I think that's a fairly positive measure, overall measure for the bond markets.
Well, yes, that's the take on the bond markets. But Nilesh, as an equity investor, what should be the strategy at this point in time? Because, well, of course, the RBI has been highlighting that the global uncertainty is definitely weighing heavy on the India as a whole. Other than that, the rural demand, the urban demand, that is holding strong. The inflation, food inflation is coming down, helping to expected to be supportive in the overall numbers. But what all has been happening with the relentless FII selling, the kind of uncertain times that we are in with respect to the tariff war, how is Indian equity investor expected to do in the times ahead? What's your take on the markets?
Never stand in front of a running train. Undoubtedly, there is a lot of uncertainty. When there is a global sandstorm blowing out, it's important to secure your house. So focus on quality stocks, focus on valuation, buy into the correction, but don't be in a hurry to deploy. President Trump will give us enough opportunity to buy into the correction.
It looks like, Mr. Shah, but on that note, I will request all of our panelists to hold on, because we just have a commercial commitment to attend to. So we'll slip into a break and we'll be back, and we'll continue with the conversation on how should one actually brace themselves, given the fact that now you have the MPC that's gone ahead with 25 basis point rate cut. But let's not forget, we are in the midst of a global turmoil. So don't go anywhere. We will continue with the discussion on the other side. Welcome back to the special coverage on the monetary policy outcome. Given the fact that you have the MPC that's gone ahead with the 25 basis rate cut, you also have the change in the stance now to accommodative from a neutral, and you also have the RBI governor actually mentioning and spelling it out actually why, what the stance or the reason why we have stance, what it actually means for the policy and how it guides the policy going ahead. Remember that this is the second time in a row that the MPC has gone ahead with the easing of the interest rates. We have our guests who are waiting by very patiently. We have Ashima Goyal as well as Mr. Dinesh Kumar Khara, who are with us. And let's take the conversation forward and try and understand actually, apart from the way, also we have Mr. R. Gandhi joining us, and we also have Devang Mehta also joining us right now. Thank you, Devang, for being a part of this. And let me actually get your views first on how you view this entire monetary policy meet outcome, the commentary coming in from Governor. Would you term this as being a tad bit of dovish commentary coming in from the RBI Governor?
So thanks for the invitation. See, our perspective is clearly RBI has probably signal a significantly dovish tone. RBI has delivered what markets wanted. RBI is probably looking at there's a significant revision in the growth. Growth has been revised downwards. Inflation has been revised downwards. They have taken very, very proactive steps in ensuring that banking liquidity goes into surplus. Like if you look across last year, we were struggling on banking liquidity and banking liquidity was a tad surplus. Today, if I look across at the market environment, the banking liquidity is significantly positive. And we believe that today's RBI's message, where they've changed the stance, delivered 25 basis rate cuts, opens up some more space for monetary policy easing. So our view is, yes, it is definitely dovish, and markets would be happy with this, bond market specifically, because they have delivered what bond markets wanted.
Right. One more important thing which Reserve Bank of India governor highlighted was a liquidity condition. Although there was no separate announcement which was made here, but the expectation was there for a CRR cut as well. There has been several announcements, OMOs, which has been conducted by Reserve Bank of India, but the expectation of CRR cut, which was there in this policy, has not been fulfilled. Mr. Dinesh Kumar Khara, I want to understand your view on this, because we understand that banks had requested to Reserve Bank of India for CRR cut.
Yeah, I think there was a request which was there, but it was essentially because, in fact, in the pre-COVID situation, there was a scope for the CRR reduction. But I would say that that particular aspect is perhaps addressed through the more and more OMOs, which will ensure that depending upon the liquidity situation, which is invariably, we have seen that it is quite volatile of late, and perhaps in the current situation where the global volatility being quite pronounced, perhaps they probably felt that they can live with the more and more OMOs as compared to going for the CRR reduction. That seems to be my understanding on why perhaps it has not been looked into. But if at all we look at it, RBI is very mindful in terms of ensuring that there should be enough liquidity in the system. That aspect is getting addressed. The tool may be different, but ultimate goal is being achieved.
All right, but on the show, we also have Radhika Rao with us, Senior Economist, Executive Director at DBS Bank. Radhika, we'll just come to you in a bit. But meanwhile, Ashima, since the change of stance is through, the RBI is clearly projecting for further rate cuts. But help us understand that how much more headroom is there for the RBI to cut the rate cuts? And in how much time do you see those comings in this uncertain times?
Yes, I just wanted to say one thing about the stance, which is the move to accommodative should give the market comfort that liquidity will stay in surplus, durable liquidity, which banks want, and they can have confidence in that. I think the RBI has demonstrated over the last 2 months that they have the tools to inject liquidity, even if there is global volatility. Then similarly, this question about market turmoil and global events, we should remember in the last 2 months, despite the tariff event threatening, we saw a reversal of inflows back into Indian markets, a recovery in the rupee and in stock indices. So this is a point I've been making again and again, that India has sufficient diversity to withstand foreign shocks. And we saw this, the depth in Indian markets and enough domestic participants. So we should not think that in the future, whatever happens with the tariffs and its effect on the globe, we have enough policy tools as well as other domestic levers to do relatively well. Markets should have that confidence. Now, regarding how much of rate cuts, and my view is that for comfortable growth, the real repo should be around 1%. The RBI has a range of 1.4 to 1.9. So that means that the nominal repo can easily go down to 5.5. And in my view, the faster this is done, reaching the neutral or the equilibrium real rate, the better it is. We had this experience in 2022 also during the Ukraine war when inflation was persistent. We had an out-of-turn MPC meeting in May and we raised the repo on 50 BPS, towards equilibrium. And that proved to be very good for the economy, helping inflation come down. while growth stayed robust. So my own view is that the faster we reach that real repo rate of 1%, maybe we can look to see what the monsoon is, but any food price inflation spike will be only a spike. It's not likely to affect that 4% forecast. So we have room to cut at least 50 to 75 BPS more. Thank you.
Right, point taken. Thank you, Mrs. Goyal, for joining us on the show, as well as Mr. Khara for being part of the discussion to talk about the Monetary Policy Committee and what to actually make out of the outcome today.